Hello and welcome. You're watching KYC, Know Your Company. It's a show designed to give the regular investor powerful, actionable insights into the fundamentals of single listed companies daily. Today we're going to look at transformers and rectifiers. Ironic because we've also looked at power grid earlier this week, and therefore transformers is the other space within the power basket which is in focus. Now this is a stock and a company which has just put out its Q4 numbers, FY25 numbers as well, and therefore of interest. Couple of days where the stock has been buzzing, and it's a space which is very interesting at this point because it's inward facing, not facing too much of that tariff impact, at least no direct impact. Now in terms of why or what the company does, it's one of India's largest domestic transformer manufacturers. Now what's a transformer exactly? It's a device that transfers electrical energy from one circuit to another using electromagnetic induction. So it's a device which allows you, when you switch on a switch or switch it off, the power to get calibrated at the back end to ensure that you are getting power. This device enables the transmission of power through the circuit or through the cable, and it also ensures voltage required to be provided. So both of those. Now in terms of products and offering, let's pull up all the products. It's into a whole host of products, to be frank, across the spectrum. You have transformers, distribution transformers, furnace, rectifier and shunt reactors. It deals across the board with all of these different type of transformers for different use cases, and therefore has that product offering, and also has it across voltages. So it covers various voltages across products as well. In terms of where is it finally utilized, largely in the power transmission and distribution segment right now. There's very heavy capex anticipated in that segment. When we were speaking about power grid, in fact, in particular, nearly 20 to 30,000 crore of capex each year annualized over the next 3 years is the capex pipeline for power grid. So you will have a very large capex coming through, nearly 70,000 crore by power grid alone, and all of that will to a large extent require transformers as well. So that's one pocket. The other one is the industrial sector. They will also require such devices. Now in terms of capacity, let's talk about how much capacity they have. That's how their capacity is split up, but largely around 37,200 MVA, all of that is sitting in Gujarat at this point. And capacity in fact can be increased to 42,000, and that will happen only if similar types of orders trickle through. So if there are 2-3 orders from the same vendor, they actually have at the current capacity the ability to manufacture up to 42,000 MVA. There's a tailwind in the transmission and distribution sector. There is a tailwind in terms of capex. You're expecting around 2.5 lakh crore of transmission capex for the next 3 to 4 years. This is as per industry and analyst estimates, of course. So this is the kind of large size that you have. This is of course across the board. It also includes wires and cables. So maybe that to be kept in mind, and not purely for transformers, but because it's in transmission and because transformers is vital to transmission, you will have this as something which is relevant. And 50+% exposure of the company is to central power transmission utilities. So you'll have all of that which will likely come through for something like a TRIL. We will speak with CSS Rajora, who is the CFO and advisor to the board of transformers and rectifiers, and we'll get a perspective, of course. But before that, let's try and break this company down. Let's try and talk about the metrics that we will talk about where this company is concerned. We'll start off with the income statement. We'll also look at the balance sheet thereafter, the cash flow, the return ratios, and then we'll look at shareholding, street cred. We look at the order book as well as the outlook that the management has given. And then last off, we look at street coverage and valuations. We've coupled a few of those metrics because order book plus outlook will give us a good understanding of how execution will play out, and street coverage and valuations will give us a good sense of how the valuation is as of today. And therefore, it will give us better perspective. That's how we've kind of broken it up. And joining me today to really help me break this and try and help you understand this better is Anushi Vakharia. Anushi tracks the power space closely and therefore is going to be helpful in trying to break this down. Anushi, let me allow you to start with the income statement.
Right. So now, since the focus right now for transformers and rectifiers is the Q4 numbers, let's start off with that. It's been a strong quarter for the business. This is led by better execution as seen by the revenue numbers. It's reported about a 32% of a growth here, while EBITDA has seen about a 83% of a growth, with the margins now standing at 19% as compared to 14%. Now, do note that in this quarter, we have seen higher or ticket orders, so because of which we are seeing this margin expansion which is there, but the company did say that for FY26 it expects this number to be the mid-teen ratio, so bear that in mind. Net profit has seen about a 126% of growth, but a couple of factors which led to this. Firstly, the higher other income along with lower cost of material is something because of which we are looking at such a high profit number for this quarter. But let's look at this annually as well. If you take the last 4 years in perspective, if you are seeing the revenue CAGR for 4 years, that's roughly about 28% of a growth is something that is what we are seeing. And net profit, however, seeing about a 135% of a growth. In fact, if we see FY25 has been a strong year for the business, seeing about a 56% of a revenue growth, margins inching upwards in the range of 16% as compared to 10%. Now, do note that the company has maintained its focus on being completely backwardly integrated. This is by FY27 it's saying. So, operational leverage is something that we should continue to see favoring the business going forward. Net profit also 216 crore is the figure that we are looking at as compared to 47 crore. Again, the factors already mentioned as to why we are looking at such a big jump in terms of where the net profit is. So strong numbers in terms of where income statement is concerned, Harsh, but let's also talk about the balance sheet, right?
Well, yes, absolutely. In fact, the balance sheet also doesn't look all that bad. They've done a couple of fundraisers to pay down on debt. You can see that reflecting in the equity share capital. Also, you can see how long-term debt has continued to remain as is, no real increase or inch up there, and so is short-term debt. Cash and bank balance is also fairly healthy at around 167 odd crore, and for a 15,000 crore market cap company, you're largely seeing debt plus cash really well placed in that sense versus the market cap of the company, and therefore no concern with regard to debt. And that's at least how this one is looking at this point. Overall, we're giving this a thumbs up because debt, not much of a concern, decent amount of cash on the balance sheet, good free cash flow coming through quarter after quarter. It's a profitable company, margins are getting better on the income statement side as well, and therefore no concerns on the balance sheet. Cash flow, Anushi.
Right, cash flow, if you see, we were just discussing about it, how for the 4-year figure, we are looking at an annual CAGR of 4-year annual CAGR in terms of where the EBITDA is concerned, roughly around 28%. But however, if you look at the cash flow from operations, despite seeing overall a healthy picture, we are seeing about a 190 crore of a position by the end of FY25. It's around a 19% of a 4-year CAGR that we are looking at in terms of where the cash flows are concerned. Overall, if we see what has happened in the course of these 3-4 years, we are looking at increase in payables versus receivables. So it's because of these receivables and the trade payables that we are looking at such variation in terms of where the cash flow from operations are concerned. If we take the net cash flows in perspective, the net cash flow for this year stood at about 3.66 crore. This is compared to the March 21 figure that we are looking at, some negative 3.6 crore number is what we are seeing. So cash flow overall, we are giving it on the neutral. That's what we are seeing for cash flow, right?
Correct. And EBITDA, in fact, Anushi, has gone up 48% on a 4-year CAGR basis, but we're not seeing that translate to cash flow. So that's something that we'll actively watch out for, because a lot of that is being diverted towards payables and receivables. Can that change will be the question, or does that remain as is? And now, can growth start to come through on the cash flow side of things? Even cash flow, otherwise, I wouldn't complain too much with regard to net cash flow, Anushi, because they are investing in fresh capex and they are doing fundraisers as well. So investing as well as financing is kind of, there is a bit of churn there, but I wouldn't be too worried about that. Okay, I want to quickly also look at the return ratios. That's something that's on our radar. Now, return ratios have been getting better it's on an improving trend, as you can see. There's also sectoral tailwind with regard to products. You're seeing a tailwind with regard to growth as well. And that top line, the operational efficiency is starting to play out on the bottom line. And I'll just quickly give you the profit number. PAT has gone up from 7 crore in March of 2021 to 211 crore in March of 2025, annualized PAT. And therefore, you can see that real sharp jump, 30x, with regard to PAT, which kind of somewhere is impacting both your ROE and your ROCE ratios. In fact, ROCE is getting even better because on the ROE count, there was some amount of debt which has been paid, and now you're starting to see ROCE really pick up well. So that 15% kind of ROCE number is now jumping up to around 28%. Whether this is sustainable or not is, of course, a big question. And they are also doing fresh capex, and therefore you might see some bit of fluctuation here. But otherwise, the kind of jump that we are seeing from mid-teens to mid-20 plus will be something that it clearly gives this one a thumbs up, especially on their FY25 numbers as margins get better. And also, whether this is sustainable or not, we'll also get a better outlook from Anushi when she covers the outlook as well as order book. So,
right.
but Anushi, why don't you take up shareholding pattern?
Okay, so in terms of where the shareholding pattern is concerned, if you take the last 3 quarters in perspective, we are seeing this promoters holding about 66% of stake in September 24, while this was the kind of shareholding that they had in June as well, coming down to 64% by the end of this fiscal year. Do note that there was a QIP which was launched in June 2024, because of which we are seeing some dilution in terms of where the promoter holding is concerned. Whereas on the other side, we have seen a pickup in terms of where the FII and the DII share is concerned. Around 9.34% was the stake that they held before, which increased upwards to around 11% of a range. And similarly also for DIIs, we are seeing this number from moving up from 7, almost 6.9 to almost 7.2%. Again, even if we see in the last 3 years, 2-3 years, what has happened, there was another QIP issue as well. So considering that overall picture, what was a 70+ % of mix that has come down to 64% by the end of this fiscal year. Public shareholding on the other side has majorly remained in the levels of 17 to 17.5%. It's where the FIIs and the DIIs have shown higher interest for the company, and we are seeing pick up in the stake of these two shareholders which are concerned, right, Harsh?
Yeah, absolutely. And promoters, just quick addition here, they've sold around 27 lakh shares, which is roughly 1% or so, in the month of October 2024. Of course, there were enough buyers to offset that, but they've done it at 780 rupees a piece. Today, stock trading at around 580. So that's probably one of the other reasons why we've given this a neutral. Also, when we're looking at the 4-year picture, promoters held around 75% of the share capital. Of course, they've diluted through QIP, they've diluted through fresh equity raise, but there has been a dilution from that 75 to 64, and there's also been a sale during the same period of time. So maybe something to watch out for. What is the future outlook maybe in the next year or two? And this has happened over the last 2 years alone. Okay, so maybe 4 years back, promoters held 75, but the real dilution has happened over the last 3 years through fresh equity as well as through one promoter sale. So maybe something to be kept in mind, and hence the neutral on this count. Let's look at Street Cred very quickly. In the last month or so, the stock is up 32%, so big thumbs up there. Last 6 months up 47% despite all the market turmoil. Last 1 year, stock is up 42%, but the 5-year picture is that the stock is up just about 40% over the last 5 years. So from a short-term perspective, has done very well. There's very good tailwind in the space, and therefore you're seeing that. But over the last 5, it's not done as well. We'll give this one a neutral as well, given that there's no sustained stock performance, right, Anushi? The small and mid-cap space has done very well in comparison to this one when you're looking at the 5-year kind of.
Very interesting picture on the short-term performance of the company, despite the kind of markets that we have seen, how it has done so far.
For
but
sure.
Let's talk about the order book position. I think that's the standout over here for the company. If you look at the order book, that stood at about 5,132 crore by the end of this fiscal, seeing about a 98% of a jump. Of course, it was supported by some high order sizes, especially the order that they've received from Getco, aiding it. Order inflows, if we are seeing, were up around 5.2 times at 2,144 crore for the year. Overall order inflows stood at 4,504 crore. And in fact, if we look at the inquiries under negotiation, the company has stated that the ratio for the number for this stands at about 22,000 crores. So strong order book positioning that the company has. Other than that, even if we look at the outlook forward for the FY26, they've already given us perspective here. Expect around 3,500 crore of revenue by the end of FY26. This is with a margin expectation of 15 to 16% is what we are seeing. The company did say that by the end of 3 years, they're aiming for a $1 billion size in terms of where the revenue is concerned. And again, in line with their targets of maintaining healthy margins, they are aiming to be fully backwardly integrated by the first quarter of FY27. Along with that, we are also looking at some capacity expansion plans which are going to support this revenue growth, including the likes of first phase of new capacity addition of 15,000 MV of IDT transformers. Along with that, some expansion happening in the EHV transformer facility as well. So strong plans in terms of capacity expansion. Also, they've outlined about 550 crore or so for the next 1.5 year. Right?
Absolutely. Now let's look at street coverage and valuations. Very quickly cap it off. There are just 2 buy calls on this one. No sell calls per se, but just the fact that there aren't enough analysts tracking it gives it more difficulty in terms of ascertaining whether this will actually come through in terms of guidance. And therefore, let's try and extrapolate what those numbers look like. The EBITDA for FY26 is expected at 525 crore. The assumptions made here is a 3,500 crore top line in FY26. That's what's been guided. And a 15% margin number, which arrives at a 30 times EBITDA as of today, as of today's stock price. The other thing is the FY28 guidance. The aspiration is to take it to $1 billion in revenue at a mid-teens kind of a margin number. If that were to come through, you will see likely the EBITDA number more than double. If that were to happen, it will trade at 12.5 times FY28 EBITDA. Again, certainly not cheap, but you'll want to look out for this one because growth is extremely strong. Therefore, a neutral. Let me quickly bring on board Dr. CSS Rajora, who's the CFO and advisor to the board for Transformers and Rectifiers India. I want to, sir, quickly first ask you, what is the sustainability of the 19% margin you've clocked in Q4? You've guided for a mid-teens margin in FY26. Is that a conservative guidance is what I'm trying to get to? Or can you clock close to a 20% guidance going forward for the next 2 to 3 years is what I want to understand.
Thank you, Harsh, for having me here. And
Pleasure having you here, sir.
Before I answer your question, I was just hearing you that you're telling me that promoter has done the block at 780 crore rupees, 780 rupees, and right now the share is 526 rupees.
Correct, sir.
But you forget to mention that this 520 rupees is after the bonus of 1:1.
Correct, sir. Yes.
So that is, and the block was done well before that.
Correct.
Right?
Yes,
So
sir.
effectively, if you see the pre-bonus, it is 1,020, 1,050 rupees price range.
Point taken,
right?
sir. Point taken. Yes.
Coming to your question on sustainable margin side, we have been guiding from the day one that the margins will remain somewhere between 16 to 17% level, and that I feel is the sustainable margin. This sustainable margin. What I am mentioning here is only and only from the transformer business. But what the backward integration activities, what we are doing is going to be help us in the margin level from 150 bps to 200 bps points from the year 26-27. So you can see that once that number will start coming up, there will be a considerable amount of shift into the margin size.
This is Anushi joining in. Now for FY27 is a year that we are looking forward. There's a lot of capacity expansion plans already. One is the IGT transformers that we are seeing, even the extra high voltage cable transformers. We are looking some of capacity expansion panning out there as well. Considering that you already have a strong growth for FY26 and 27, you're targeting around a 3,500 crore of a revenue here. Just want to understand the picture from you in terms of where these capacity expansion plans are concerned. What is the kind of utilization rates that we will look forward from the first to second year onwards? How do you plan to increase it so far? And what is the kind of margins that we will see after once all these new capacities are on stream?
Usually, we are very quick in implementing our plans. In April last year or March last year, we have guided that we will be achieving a 2,000 crore rupees number in this March, and we have achieved that by implementing our planning in a very proper manner. In March, we had started one capacity expansion of 15,000 MVA, and I'm happy to say that next month that will be start the commercial productions. Right. Apart from that, we are also coming up with the expansion of 22,000 MVA in the extra high voltage transformers, and that is going to be in place from February, March next years. This will take us to close to 70 to 75,000 MVA. But here also there is going to be a good amount of the capacity addition because of the operational efficiency and because of the backward integration activities we are doing. And these things are going to add up into my capacity at least by 15%. So that is the expansion size or criteria what I am telling you. As far as demand side is concerned, see today we have 5,000 plus crore rupees of demand of order book, and we are aiming to the 8,000 crore rupees of order book by end of this financial year. And this does not include the any business any order from the capacity expansion which is coming now. If we add up that, then this is going to be at an increase further. As far the utilization of the capacity is there, though we have achieved 29,000 MVA this year, but we feel that we are still underutilized. So we aims to utilize our facilities by 80 to 85% by close of the next year, and that is where we are targeting into that.
Mr. Rajora, what I would also want to understand from you is what are the risks to this tailwind in terms of demand? You're in a positive cycle, you're setting up capacity, no doubt, with regard to both capability on execution as well as setting up capacity. There's no doubt financially in terms of balance sheet strength, you're there. But what could the downside risk be? Could orders inflows start to taper is really the question, and what's the risk of that?
There are two risks which I tell you. The first border risk is that development of the country is stopped, or our grid expansion has stopped, which is not going to be happen because the way we have been interacting with the agencies and the government agencies, they are just behind us on the supply side, right? They almost their representatives are at our office, and they want the supplies to be streamlined as fast as possible, and our productivity should increase as early as possible. And they are now not discussing with us 1 year requirement, 2 year requirement. They are discussing with us next 5 years requirement, that how much we can give in next 5 years. Just to give you a very small example of the distribution plan which has been laid down by CEA, as per that plan, from this year, from last year basically, to 2030, CEA has predicted that 392 numbers of 200 MVA plus transformers required every year. And we are not giving them half of that so far because we don't have the capacities. Plus 190 numbers of reactors are required, and we are not giving 1/4 of that reactors. So there is, I don't feel that any demand supply issue is there. Industrialization is growing very fast. Private players are coming up, and it's the renewable energy requirement is going to add up this further, because by next year all the big solar farms are going to come on the commissioning stage, and they will require huge number of IDT transformers.
Got it.
The IDT facility, what we are putting up, big players are talking to us just to block our facility.
Mr. Rajora, sorry, I'm going to take maybe 10 seconds in terms of a question. The export demand is extremely strong. There's a 3-year lag there. If you can explain in 30 seconds, why would you want to keep exports capped?
Very, very, very simple answer is that for us, India is first.
Okay, point taken. Thank you so much, sir. It's been a pleasure speaking and understanding this, but completely out of time on this edition of KYC. Thank you for coming.
Thank you, and I'm really impressed with the detailing what you have done about our company. Thank you,
sir. Thank you. Thank you for that compliment. Thank you. Of course, Anushi has really worked hard on this one. So thank you. Thank you. But anyway, out of time on this edition of KYC, we're going to quickly look at the rating very, very quickly. Income statement, thumbs up, balance sheet, cash flow, return ratios. And we had shareholding, street cred. We also had order book outlook and street coverage, thereby giving this one a 6 out of 8 on our KYC rating. Completely out of time on this edition of KYC. Stay tuned to NDTV Profit. For now, it's a thank you from Anushi, myself, everyone who puts the show together.